Have you ever pondered if the gain on stock can be loftier than the interest on a loan? This curious thought might have crossed your mind on numerous occasions, especially if you're someone who likes to indulge in the mysteries of finance. It's an interesting conundrum, one that intrigues not only the seasoned investors, but also those who are just beginning to dip their toes into the vast ocean of finance and investment. This concept, as perplexing as it may seem at first glance, is not as complicated as one might think. It's a question that has the potential to change the way you view your financial investments, and can very well be the key to unlocking the door to significant financial gains. After all, who wouldn't want to increase their wealth and pave the way for a secure financial future? To truly understand this concept, we'll have to delve into the nuances of both stocks and loans. Stocks represent ownership in a company and are often seen as a high-risk, high-reward investment. They have the potential to provide significant returns, but their value is also susceptible to market fluctuations, which can result in losses. On the other hand, loans are a form of debt. When you borrow money, you're required to pay back the amount with an additional interest. This interest is often seen as a burden, but it's also a cost of borrowing that you agree to pay when taking out a loan. The interest rate on a loan is usually fixed, meaning it doesn't change over the life of the loan, unlike stock prices which can fluctuate based on market conditions. So when you juxtapose the potential gains from stocks with the interest on loans, it poses an interesting scenario. Can the returns on stock investments indeed be greater than the interest that accumulates on a loan? Well, it's a complex question that requires a deep understanding of the financial market and a thorough analysis of your personal financial situation. But don't be overwhelmed. We're here to help you unravel this mystery. Today, we're going to delve into this concept, breaking it down into easily digestible bits. It's time for you to sit back and relax as we take you on a journey through the fascinating world of stocks and loans, where we will explore the potential benefits and pitfalls of each, and ultimately help you answer the intriguing question: can the gain on stock be loftier than the interest on a loan? Let's begin this exciting exploration. Imagine this. You've bought a stock and it's doing wonderfully. Now, if you're new to the world of stocks and finance, let me break it down for you a little. The stock market is a place where buyers and sellers trade shares of a company, and these shares represent a piece of the company's assets and earnings. When you buy a stock, you're essentially buying a piece of the company, hoping that the company will do well and of the stock will rise. That's the crux of it. So you've bought a stock, invested your hard-earned money into a company you believe will thrive. The company indeed starts doing splendidly, surpassing your expectations. Things are looking up, and you can't help but feel a sense of pride and accomplishment. You've made a smart choice, a calculated risk, and it's paying off. The price of the stock, the value of your share in the company, starts to climb. It's a beautiful sight, isn't it? The numbers climbing, your investment growing. Before you know it, the gain on this stock, the profit you're making, is towering above the interest rate on a loan you've taken. Now, this loan could be for anything: a house, a car, a business venture. The interest rate is the cost of borrowing that money, a percentage of the loan that paid to the lender in addition to the money you borrowed. Here's where the magic happens. You notice that the gain on your stock is higher than the interest on the loan. In simpler terms, the money you're from your investment is more than the money you're losing through the interest on your loan. It's a moment of realization, a moment of triumph. You've not only made a sound investment, but you've also managed to outperform your loan interest. The thrill, the joy, the sweet taste of success. It's quite an experience, isn't it? You've tactfully navigated the unpredictable landscape of the stock market, made a smart investment, and reaped the benefits. If the gain on your stock is higher than the interest on the loan, you've made a profit. It's a rewarding feeling knowing that you've made a profit. It's not just about the money, but also about the validation of your decision, the affirmation of your acumen. Quite simple, isn't it? Now, let's add another layer to this. The concept of paying interest on a loan seems daunting at first, primarily when juxtaposed with the prospect of cashing out your profit from the stock. However, there's a fundamental financial principle that comes into play here. When examining the bigger financial picture, it is crucial to remember that the monetary system operates on a complex network of exchanges, transactions, and deductions. Consider this. The interest you pay on your loan may seem like a substantial sum, yet when compared to the tax you'd end up paying if you decided to liquidate your stock profits, you'll notice an intriguing financial paradox. This paradox lies in the fact that the payment on your loan could unquestionably be lesser than the potentially hefty tax you'd incur if you cashed out your stock profits. A peculiar concept, isn't it? It almost defies conventional wisdom, leaving one questioning, how could this be possible? However, this is indeed the reality. The mechanics behind this phenomenon are intertwined with the way our financial and tax systems function. When you take out a loan, the interest you pay is usually seen as a necessary expense, a cost of conducting business. This perception of interest payments as a business expense is deeply ingrained into our financial system and tax laws. In essence, it means that these payments are often tax deductible. Switch gears for a moment and consider the tax implications of liquidating your stock profits. Profits from stocks are seen as capital gains in the eyes of the tax authorities. Why does this matter? Well, capital gains are taxable income as per the taxation laws. This means you are obligated to tax on it, unlike interest payments which can be written off as a business expense, reducing your overall taxable income. When we delve deeper, we see the financial ideologies at play, revealing a mosaic of transactions, deductions, and financial strategies. These strategies aim to maximize gains and minimize losses, providing a pathway to wealth accumulation and financial stability. So, in effect, the interest on your loan could end up being less than the tax you'd pay on your stock profits, leading to a net gain. Weaving through this intricate web of financial systems and tax laws, we realize that sometimes the most counterintuitive strategies can yield the most significant economic benefits. It's a fascinating journey, one that continues to mold our financial landscapes and shape our economic futures. To summarize today's exploration, if the gain on your stock is greater than the interest on your loan, you've made a profit. Moreover, the interest you pay on that loan could potentially be less than the tax you'd pay if you decided to cash out your stock profits. This isn't just a theory, it's a practical strategy used by many savvy investors to maximize their profits and minimize their tax liability. It's a game of numbers and knowledge, and understanding these concepts could help you come out ahead. Remember, every financial decision should be made with careful consideration and sound advice. It's always wise to consult with financial advisor or tax professional to understand the potential risks and rewards. In the world of finance, understanding is power. The more you know, the better equipped you are to make informed decisions. So keep questioning, keep learning, and keep growing your financial wisdom. Thanks for joining today's journey into the intricate world of stocks, loans, and taxes. Please note, this video is purely for informational purposes and should not be used as financial advice. Always consult with a professional before making any financial decisions. Let's now dive into a real-world example. Imagine you've taken out a loan to buy a house. This isn't just a purchase, it's an investment. The value of the house, your equity, appreciates over time, increasing your net worth. But that's not all. Let's say you decide to rent out this house. Now, it's not just a static asset, but a source of regular cash flow. This income can be used to pay off your loan, or even better, to invest in other areas such as stocks. Now remember the loan you took to buy this house. While it's a liability, it also provides a unique opportunity. The money from the loan can be used to invest in the stock market, potentially earning more than the interest you're paying on the loan. In this scenario, your understanding of the interplay between loans, investments, and taxes is key. It can lead to financial growth and a more secure future. This is the power of financial knowledge in action. Remember, the more you learn, the more you earn.